Good evening. It is time for today's Tax Talk. I'm your host. I'm attorney Stephen Leahy. It is Wednesday, February 2nd, year of our Lord 2022. And we're going to talk about the IRS today and audits. Everybody wants to know, how do you avoid an audit? Well, that's what we're going to talk about today. Won't you join us? Yep. So that's what we're going to talk about. Audits. I was going through the news, as you know, is my want. I go through the IRS news, and I saw that there was some articles about the 7 reasons people get audited by the IRS. So we're going to go review that. But I did an article many years ago from 2015, I believe, and I listed 9 things. So we'll go through both of them. If there's a difference, I think it's that's probably valid, and that you should know about all of the reasons why. We'll compare notes. So let us do that. Let's go to it. Okay. Now this is the article that, not from me, the top 7 reasons people get audited by the IRS. In the 2022 tax season, certain behaviors will put you in the IRS's crosshairs. Here's how to avoid them. Okay, so I'm going to go, let's do the next one. This is my article from, I think it's from February 26th, 2015, some years ago. And so let's just review it. I'm on the wrong site. I should probably put myself somewhere. Well, that's fine. There we go. That's a little better. Okay. The IRS calls an audit an examination of returns. They have their own language. The IRS accepts most federal tax returns just as they are. Some returns, however, are selected for review. The IRS selects returns for audit by computerized screening, random sample, or by an income document matching program. And this is what I've been talking a lot about the 1099K and these correspondence audits, they're called. An examination can take place in several ways. Some audits are handled exclusively by U.S. mail. These are the correspondence audits. An examination can take in the taxpayer's home or place of business, at an IRS office, or at your representative's office. That's the best way to go. You don't want to go into the IRS office, in my opinion. The time, place, and manner of the audit are negotiable. Here are 9 red flags the IRS uses to select a return to audit. Make a mistake on your tax return. Now, this is really what caused a lot of the problems now that we're facing from last year and the year before, because many people made mistakes about their earned income tax credit, the workers' compensation, and the unemployment compensation, and the other, the stimulus check, and people handled all those mistakenly on their tax returns. And then, so that kind of was an audit in that they took time for them to review it. Round off the entries of your tax form. Generally, life doesn't happen in round numbers. If you use round numbers, it tells the IRS that the numbers may be fictitious or at least not accurate. Makes sense, right? File late or not at all. When you file late, the return is not processed with the horde of annual filers. Instead, your return will be processed by a person looking at the details of your return. I don't know how accurate that is 7 years later, because more and more returns are done electronically. Be a tax protester. Tax protesters don't believe the IRS has a legitimate authority to collect taxes, and they thumb their nose at the IRS by filing returns that indicate zero tax owed if a tax protester files a return at all. Tax protesters can count on the IRS assigning a revenue agent to review it. That's the IRS. If you're a tax protester, they throw the book at you. And this is what happened to Wesley Snipes. He was a tax protester. And they ultimately got him for 3 years because he had 3 years of unfiled tax returns. Technically, an unfiled tax return is a crime. There is a crime, and it's punishable by up to 1 year in prison. And he had 3, so they gave him 3 years in prison. They could have given him much more for tax evasion or these other matters, but that's how they resolved that matter. but I don't believe he's a tax protester any longer. He's paying his taxes. Have unreported foreign accounts. Foreign banks have been reporting American account holders to the IRS for some time now, longer now, and almost all foreign bank accounts are reported to the IRS. So even if you don't report the foreign account, you can be assured that the foreign financial institution will. Don't report some in company. And here's again to the 1099-Ks that we were talking about. Companies are to issue a 1099 for any payments over $600 or W-2s to employees. So if you don't report some income, the company that paid you will likely report the payment in a 1099 or W-2, and the IRS will have the paperwork to match against your return. And again, this is all done electronically. They don't even have to look at it. Claim large charitable contributions. This is an easy target for the IRS. The IRS can simply audit you by mail and ask for substantiation. So if you're given a lot of money, and a lot of people do, a lot of people are 10%, some people do more, and you can prove it, well, then you're going to get it. But they're going to take a look at it because this is where people exaggerate, I should say. Take a repeated loss on the home-based business or any business in that matter. If a business loses money 3 out of 5 years, the IRS considers the activity to be a hobby, not a business, even though that's not what the law is. If it is a hobby, you can only deduct losses equal to or less than the income. You can't use the losses in a hobby to offset taxes from other income. That's true. Again, they're not always hobbies. Use an unscrupulous tax preparer, and I've talked a lot about this, that if you use a tax preparer that exaggerates, you're going to get audited. They'll audit when they come down, and they will find that person. They will audit all of the returns that person has done. When the IRS notices a specific taxpayer is preparing returns that generate large refunds, the IRS is likely to audit all the taxpayers who use that tax preparer. So be careful who you hire. It generally makes sense, right? Generally, the IRS has 3 years from the date of due date to audit a return. That explains why the IRS will usually conduct an audit for 3 consecutive years rather than just one. There are exceptions to the 3-year rule. For example, if you underreport your income by more than 25%, the IRS has 6 years to audit. If a taxpayer files a fraudulent or false return, there's no time limit on the audit. So if you are facing an IRS audit, or if you already have been an audit, you should work with the local law firm. And that's just me at the end of there saying, call me. We help people deal with IRS audits. So this is the other article. The top 7 reasons. I had 9 reasons. So let's go through these. Missing paperwork and undeclared income. Tax season is underway with millions of Americans putting together their returns for fiscal year 2021. While less than 1% of all taxpayers are audited in a given year, movies and TV shows have helped create a horrifying fear of trudging shoeboxes stuffed with receipts into the IRS's agent's dimly lit office. According to the agency's website, an audit is simply a review of accounts and financial information to ensure information is reported correctly according to the tax laws and to verify the reported amount of tax is correct. That's what it is. Often an audit will be triggered at random, and they do random audits. Many are random. But certain kinds of taxpayers and certain behaviors are more likely to draw the IRS's attention than others. Here are 7 common reasons you might be audited and what you can do to lessen the odds. Okay. Find out what. Okay, whatever. You have missing or mismatched paperwork, and we already talked about that, right? That's the 1099s. They send you one, and you don't send it in. Then they know that it's there, and so that'll create a correspondence audit. The last year, the federal government offered a variety of financial support programs to offset the economic effects of the pandemic, notably the child tax credit and the earned income tax credit, and a third stimulus check. Remember, these are the things I already mentioned. And the American Opportunity Tax Credit, which allows you to claim up to $2,500 in education expenses. But you have to show you legitimately qualified for these benefits. If last year you claimed no child tax credit and this year you claim 3 kids and they're not babies, it's going to trigger a letter from the IRS. That doesn't mean you're always in the wrong. You might have had a child in May 2021, and the IRS is working off information that it has on you from 2020. While the Earned Income Tax Credit is aimed at lower income households, taxpayers who claim it are among the most likely to be audited because you're getting money that you haven't paid in, according to the 2021 report from the Treasury Department. That's because fraud is so rampant. According to the IRS, some $16 billion, or 23.5% of all these payments, were improperly paid. 23.5%. Math or data errors. We talked about the math error letters that went out to the IRS on this show. While simple math errors won't usually trigger a full-blown examination, they will garner an extra look and a slowdown of completion of your tax return, even if the error is in the IRS's favor. So if you are entering your Social Security number wrong, transposing the numbers on your address, and other boneheaded blunders, filing electronically cuts down these follow-ups by pulling in a lot of information from previous returns and letting you load your W-2s and 1099s directly into the system. These errors aren't what they used to be, right? Most people are not filing. Although if you're filling out TurboTax or some of these free tax returns, remember, if you go to tinyurl.com/T3 free file, you can find where to file your tax returns. You can get that tax software for free from the IRS. If you make less than $73,000, it's there. You're self-employed. If you work for yourself and have legitimate business expenses, you should feel empowered to take them. Just make sure you have receipts and documentation to back it up. My advice to people who do their own business is get it off of your personal tax return. Start a business. Do it the proper way. Get the business to have their own tax return. And then a lot of these things won't be so scrutinized. If you claim the home office deduction, it has to be a space used solely for your work, for example, not the dining room table. If you claim transportation expenses, you'll need documentation of the mileage used for work. If you deduct 100% of your personal vehicle as a business expense, it's going to raise a flag. Being diligent is especially true when deducting business meals. In the past, they were only 50% deductible. Now you can claim 100% of the cost of a business meal. But you have to document who you are with, what the purpose of the meeting was, the date of the meeting, and so forth. And of course, keep the receipts. The largest percentage of Americans who are audited make over $1 million a year. Well, that's in a percentage-wise, that's probably true. You make a lot of money or no money at all. Higher income taxpayers are more likely to be reviewed, but we're talking less than 1% of the total population. According to the IRS, 2.53% of the earnings between $1 million and $10 million were audited, and 8.1% of Americans who made $10 million or more were audited. That compares to less than 1% for all tax brackets under $1 million that year. The one exception was those declaring no positive income, 4.47% of whom were audited. A negative income could be the result of capital losses or declared business expenses, which the IRS will want to scrutinize. You're in the safest position if your total household income is between $25,000 and $200,000, according to the agency. You claim too many business expenses. Now, this is where these bad taxpayers do. They exaggerate these kinds of expenses, or they take them out of whole cloth that you don't really have a business, and they take business deductions. I've had clients who this happened to. They didn't even know it. I know you sign your return under penalty of perjury, and so you should look at your return and know what it means. But people say, well, I don't understand tax. That's why I have a tax preparer. And so they gave me my tax return. They say, sign it. I sign it. I don't know what it means. You are required to file a Schedule C form if you have business income, but it complicates your return and can make you more likely to be contacted by the IRS. She encourages taxpayers to claim every deduction they're legitimately entitled to, but she adds, you have to be extremely diligent in justifying those deductions, providing details and supporting paperwork, especially if it's on your Schedule C. Better, again, to have a separate return for the business. By and large, the IRS algorithm is looking for deductions that are outside the norm for people in your profession. The IRS has so much data, right? Everybody that's in your business files with the IRS. So everybody in your business, in that code, they know what the average deductions are. What are the average expenses for this type of business? And if yours vary than what their normal is, well, they're going to take a closer look at you. And if you're taking a loss on your business for several years in a row, the IRS might want to make sure that your business is above board. According to this gentleman, small business owners who keep sloppy records often make frivolous business deductions. Actually, many people, even if most people who don't take frivolous business deductions, still don't keep good records. Most people don't. When the business owner makes up expenses and deductions, they tend to stick out. Under an audit, the IRS will require support and proof of deductions, and if not provided, these deductions will be disallowed. On a similar note, businesses that try to take incentives and credits that they don't qualify for can cause a red flag. Your charitable deductions are outsized, and we kind of talked about this already. If you itemize your deductions, you can claim cash donations to recognize charities, as well as the value of donated car, clothes, and other property. But if the IRS notices if these the donations seem out of whack with your income, the agency's computer system called the discriminant information function continuously scans tax returns for anomalies. And these are easy to, right? You know, if they just put in there, if your charitable deductions are more than this percentage of your income, just kick it out to us. We're going to take a look at it. If you say your salary was $500,000 last year, but you claimed a charitable deduction that's like half your income, it's going to catch an eye. For the 2021 tax year, the IRS actually suspended the typical limits on charitable contributions. Individuals are allowed to deduct charitable contributions worth up to 100% of their adjusted gross income. But doing so is likely to draw scrutiny. Makes sense. How are you living if you give it all away? You have undeclared income. This is a big one. Employers are required to file W-2s with the IRS that reflect your earnings, or 1099 in the case of freelancers and contractors, and now PayPal and all, and Venmo and all that. The agency's computer automatically checks to see that you submitted your reported income matches up with what was your boss submitted. If it also gets notified of interest of your earnings from savings account, investments, stock trades, as well as large gambling losses, inheritances, almost any other kind of income. Sell your house, you get a 1099, right? And so you have to account for it. If you fail to report capital gains on cryptocurrency trades, it could trigger an audit. Even if you, and I have many clients that's what's happened to them. Even if you work in a cash business like a waiter or babysitter, unclaimed income can catch up with you. If someone is bringing their child to you to care for, they're probably claiming your service on their taxes. So you need to make sure it all aligns. Even a small business like a house painter will require you to be bonded. That will eventually cross the IRS's desk. For instance, if you declare $20,000 in income on your tax return, but when you apply for a home loan backed up by the Federal Housing Administration, you put down $80,000, these departments talk to each other, and eventually it's going to get you caught. Small business owners who don't keep good records also tend to underreport a major audit risk. Because the business owner hasn't kept up with their income for the entire year, when it's time to file their taxes, they tend to estimate. The problem with this approach shows up because most of the income earned has been reported to the IRS on Form 1099. The IRS can match the income reported on the owner's return to the income reported on 1099. That's why they're doing it. That's why they're getting the Venmo and everything. The IRS also accepts tips from concerned citizens. Your disgruntled coworker or aggrieved in-law may be only too happy to report you for tax fraud, especially since the agency's 2006 whistleblower program increased incentives to potentially between 15 and 30% of the proceeds the IRS collects. How far can the IRS go to audit you? Generally, the IRS will include, and we already did this, if you identify a substantial error, how long should we hold your old tax records? Since the IRS typically looks at returns for the past 3 years, it's a good rule of thumb to hold your records for at least that long. 6 or 7 years is fine if you really want to cover your bases, since the agency itself says it won't go back further than that. The 3 kinds of audits. Typically, the IRS sends 3 different kinds of notifications: adjustment letters, correspondence audits, which we already talked about, and examination audits. Adjustment letters simply let taxpayers know they owe additional money or that there is a change in their refund amount, typically because of a miscalculation. People get a letter from the IRS and they automatically freak out and think it's on audit, but it's really just an adjustment letter. A correspondence audit is a bit more involved. It lets the taxpayer know additional documentation is needed to complete their return. The IRS might ask for receipts, bills, employment documents, canceled checks, legal papers, loan agreements, shareholder reports, or even ticket stubs. An examination audit is when people are really scared of, but less than 1% of Americans are audited in a given tax year. If you have the documents, send them to us. If you do receive a letter from indicating the IRS is conducting an examination audit, you might want to solicit professional help, she says. Well, that makes sense. The process may be conducted through the mail or more rarely in person. When an audit is completed, your IRS auditor will determine what's required to rectify the situation. If you disagree, there is an appeals process. Some of the things that get flagged by the agency are no big deal, and the IRS is not always right or not fully right. In 2018, 30,000 of the 1 million or so audits conducted resulted in taxpayers getting additional money back. That's not a very big. It's always a pleasure to resolve an issue with the IRS when it's in the taxpayer's favor. Well, that makes sense, doesn't it? Anyway, that's where we are. I thought it was interesting to know what those are. So remember, I'm going to ask you to like and share. I want to mention that I was interviewed today by Mike Gallagher, the Mike Gallagher Show. It should be airing tomorrow, Thursday or Friday. They don't know. It was recorded. And he had some tax questions, and he wanted to ask somebody who knows the answer. That's why he asked me, and I gave him the answer. So I'm going to ask you to like and share. Please like and share. We need your help. We need your support to let others know what we're doing. So thanks so much. And also remember, if you're fighting the IRS, fight the IRS. What's the first thing you do? Everybody knows what the first thing to do is, right? First thing you do, you get a copy of my book, Deal with Your IRS Problem Today. That's the first thing you do. Deal with your IRS problem today. Go to freeirsbook.com. Freeirsbook.com. Get a copy of the book for free. So thanks so much for watching. Tomorrow's Thursday. We'll be back here with you, and I hope you join us. Thank you.